For the first time since the early 2000s, stock markets outside the US have actually collectively outperformed the US market. I mean, we're talking 5 consecutive quarters here,
Yeah,
a full trailing year.
right, which is definitely a stat that should stop you mid-scroll.
Yeah.
But if you think this means the whole developing world is just booming in some synchronized harmony, you're, well, you're kind of falling for a statistical illusion.
Yeah, it really is an illusion. And our mission for today's deep dive is really about deconstructing this massive headline. Because when you hear emerging markets are winning, you probably picture like commodities surging, new ports being built, right?
Yeah, a rising middle class across Latin America and Southeast Asia,
Yeah.
that broad, rising tide narrative is what we've all been taught to expect.
Exactly. But when you actually dissect the data, the reality is completely fractured. It's a tale of two completely diverging realities. On one side, you have this absolute AI chip-driven frenzy in East Asia, and on the other side, a quiet domestic-powered revolution happening in India.
Which is wild, because it forces us to completely rethink what it even means to invest globally. The old categories are essentially just breaking down right in front of us.
Okay, let's unpack this because we really need to figure out what is actually driving this massive emerging market index rally. The MSCI Emerging Markets Index is beating the S&P 500, but where is that momentum coming from?
It's coming from semiconductors.
Oh,
I mean, specifically AI-linked semiconductor companies in just two places, Taiwan and South Korea.
wow, just those two.
Yeah. To put the scale of this into perspective, South Korea's benchmark stock index, the KOSPI, is up roughly 87% year to date.
Wait, 87%?
Yes, and Taiwan's primary market is up over 50%.
Mm-hmm.
What's fascinating here is how this completely transforms the emerging market index. We are seeing numbers that totally redefine a tech hardware cycle.
But a whole country's stock market doesn't just jump 87% in 6 months because of, like, general economic health. That suggests some extreme concentration.
Oh, extreme is definitely the right word. Just three companies, TSMC in Taiwan, and then Samsung and SK Hynix in South Korea, they now make up nearly 30% of the entire emerging markets index.
That is insane.
Yeah.
So almost a third of the weight of the entire developing world's stock market is resting on just three corporations.
Yeah, exactly. And to understand why, you have to look at the AI arms race. TSMC is actually fabricating the chips, the cutting-edge physical processors.
Right.
But processing power is only half the battle, right? The other half is memory. Standard memory chips are like a single-lane road, so the data gets jammed.
Because if you have a processor moving at light speed, but it can't access data fast enough, the whole thing bottlenecks.
You hit the nail on the head. So the industry shifted to something called high bandwidth memory, or HBM. It's essentially a vertically stacked 16-lane superhighway attached right to the processor. And Samsung and SK Hynix totally dominate that global market.
Okay, so when the hyperscalers, the Microsofts, Googles, Amazons of the world announce they're spending billions on AI data centers, that money isn't staying in Silicon Valley.
Not at all. It's basically boarding a flight across the Pacific and landing directly on the income statements of those three Asian hardware giants.
Which really makes the traditional concept of portfolio diversification look kind of absurd.
Hmm.
Buying an emerging market index fund right now is like ordering a global fruit basket, expecting apples and oranges from dozens of countries.
Right.
But then you open it up and discover that 30% of the basket is just three massive pineapples. And if an investor already holds U.S. tech stocks like NVIDIA and then buys an EM fund for safety, aren't they just doubling down on the exact same AI infrastructure risk?
Oh, 100%. You are making a leveraged bet on global AI spending through a different vehicle.
Yeah.
If those hyperscalers signal a cut in their 2027 budgets, the foundation of this whole EM rally just vanishes.
So the whole basket is ruined if those pineapples rot.
Exactly. And that's before we even touch the geopolitical reality. I mean, Taiwan is sitting on a heavily militarized fault line, but global allocators are just turning a blind eye to the threat of a Chinese blockade because the FOMO on AI chips is just so strong.
Okay, here's where it gets really interesting. Because if the emerging market story is being hijacked by AI hardware, what is happening to the other massive player in the EM space? I mean, what about India?
The contrast could not be sharper. The story unfolding in India right now has virtually nothing to do with AI hardware. They are missing out on that upside completely.
Yeah.
Global allocators are actively voting with their feet.
Right, because if you're mandated to chase growth, you go to East Asia.
Exactly. Foreign portfolio investors, or FPIs, pulled roughly $30 billion out of Indian equities in 2026.
Man, $30 billion just walking out the door.
Yeah, and it was incredibly rapid. In just a 3-week window in April, Massive foreign capital rotated out of India and directly into AI hardware. We're talking $1 billion shifting to Korea and $1.5 billion to Taiwan almost simultaneously.
But wait, here's the paradox. The math on the ground in India does not reflect a country that just took a $30 billion hit.
No, it doesn't.
India's major stock indexes are on a tear. I mean, the Sensex just hit 77,410, capping a 5-session win streak. The Nifty is trading comfortably above 24,000. How is the floor not collapsing?
Because India is experiencing a classic domestic cycle rally. It's completely decoupled from the foreign sell-off. The growth is being led by domestic banks, auto names, and real estate.
Even with the massive IT majors kind of dragging the index down.
Yeah, exactly. The domestic structural tailwinds are just overpowering the tech drag. Primarily, the Reserve Bank of India has delivered over 100 basis points of rate cuts through the end of 2025.
So borrowing is cheaper, stimulating consumer spending.
Precisely. Plus, there's a huge geopolitical luck factor here with energy costs. India imports the vast majority of its crude oil, and the recent U.S.-Iran interim ceasefire caused global oil prices to drop significantly.
So cheap oil is functionally equivalent to a nationwide tax cut for them.
Exactly. But to your earlier point, even with cheap borrowing and cheap oil, you still have to reconcile the raw mathematics. $30 billion of stock was sold by foreigners. Someone had to be buying those shares to prevent a collapse.
Right, so who is the unsung hero here? Who's absorbing that volume?
If we connect this to the bigger picture, this is probably the most profound structural shift in global finance right now. The entity buying those shares is the automated Indian retail investor.
The SIP, the Systematic Investment Plan.
Yes. For the first time in over a decade, Indian domestic institutions own more of the market than foreign investors do. FPI ownership has plummeted to 14.7%, which is a 14-year low.
Wow. So India is absorbing the blow entirely internally. It's like, well, think of this SIP structure like a massive financial shock absorber.
I like that.
If the market is a car on the highway and foreign money is a passenger who panics at a pothole and jumps out, usually the car would swerve and crash. But the automated domestic SIPs just absorb the impact and the car just keeps gliding forward.
That is exactly what the data shows. During the worst foreign selling months, domestic SIP inflows actually hit their highest levels of the entire year. It isn't about investor bravery. It's the power of automation removing the emotional panic exit decision.
Because the money just keeps auto-deducting from paychecks.
Right. At India's massive scale, automated financial discipline has evolved into a literal macroeconomic force.
That is just wild. But, we can't just say all foreign money left India because that's not entirely true, is it? We need to look at the nuance here.
This raises an important question about how we categorize foreign capital. Because foreigners aren't abandoning India entirely. They're actually heavily buying Indian government bonds.
Really? Why the split? Why dump stocks but buy debt?
It comes down to index inclusion.
Yeah.
Indian government bonds were officially added to major global bond indices, like JP Morgan and Bloomberg. So passive index funds are mechanically obligated to buy billions of dollars of Indian debt to match the index weighting.
Wow, okay. So there's this steady, mandated river of passive capital flowing in. And broadly speaking, dollar weakness has probably helped all these emerging market assets too, right?
Oh, absolutely. A weaker dollar makes servicing dollar-denominated debt much cheaper for developing nations. But that's a double-edged sword. If the U.S. Fed delivers a hawkish surprise, the dollar strengthens, and that tailwind reverses instantly.
Which really highlights the fragility of both of these rallies. Let's look at the hidden risks. For Asia, we talked about the hyperscalers. If they signal cautious 2027 budgets or if AI capex decelerates, the whole EM index could unwind rapidly.
Yeah, the concentration risk is a massive Achilles heel. Active EM funds are actually splitting up because of this. Some are specifically targeting small-cap AI supply chains, while others are launching funds focusing purely on Indian domestic consumption to avoid the tech cycle completely.
And what about India's risks? I mean, the bull case relies on RBI accommodation and cheap oil, but that U.S.-Iran ceasefire is only interim.
Exactly. If conflict resumes, oil prices jump. And for an import-dependent country like India, an oil shock is brutal. It would drive up inflation, and the RBI would have to stop cutting rates.
Which would slam the brakes on the banks, autos, and real estate sectors leading the rally.
Right. And we don't know how the SIP shock absorber will perform against a severe internal recession.
So what does this all mean? When you step back, the label emerging markets is basically masking two completely different stories. You've got an AI hardware supercycle in East Asia, and an automated, consumption-driven fortress being built in India.
It really is two different worlds.
Yeah.
And it leaves us with a final thought to mull over.
Yeah.
If automation and SIPs can permanently stabilize a massive emerging market against a $30 billion foreign exodus, are we entering an era where developing economies no longer need the West's capital to thrive?
Oh, wow.
And if so, what happens to the global financial power dynamic when these emerging markets realize they have already emerged?
That is a fascinating shift in gravity. Thank you so much for joining us on this deep dive. It is incredibly rewarding to discover the real stories hiding right behind the headlines, and I hope you found it just as eye-opening. We'll see you next time.